Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello everyone and welcome back to another episode of Blind Spot. Today we are going to be talking all about the cycle of investor emotions.
Investor psychology, as I like to call it. And, a lot of people are worried right now. They're nervous, and we want to speak to those feelings. They're completely normal. Markets are made up of humans trading with other humans, and markets are simply a reflection of how we feel about risk. And it's understated. Not a lot of people talk about the behavioral side of investing, but I think it explains quite a bit. Sometimes investors can behave rationally, sometimes they can go off the rails. And, there's this hypothesis that markets are always efficient, and that's the academic version. I think markets are mostly efficient, but sometimes they're very inefficient, and that inefficiency is human emotion.
I've got a great quote here. So Mark Twain famously said that history doesn't repeat itself. But Theodor Reich, a psychoanalyst, expanded on that thought in 1965 in an essay titled The Unreachables. And he said that there are reoccurring cycles, ups and downs, but the course of events is essentially the same with small variations. It's been said that history repeats itself. This perhaps is not quite correct. It merely rhymes.
Yeah, and I think that segues perfectly into what we're going to talk about today. So there's various human psychology graphs that overlay with a market cycle. So we're going to include the link in the show notes, but just imagine a line graph going up, which reflects the price of the stock market. Okay, so as the market goes up, we're going to talk about the various emotions that come with that upswing in stock prices. Okay, and then conversely, on the way down, we're going to uncover some of the emotions that accompany a market drawdown and what leg of the cycle that we're currently in today. So we're not fully through the full emotional cycle, but we've made quite the journey on the upswing and now on the more uncomfortable side, the downside.
Yeah, so we are going to be walking through the timeline of about 2010 to present day 2022. So let's kick it off in 2010, 2011, the optimism building stage.
Yeah, so this is coming out of the financial crisis when most investors had PTSD. Yeah, I think the S&P was down almost 40%. That was a very difficult time in this country, really across the world. And investors were looking for any green shoot. Like there was a saying back then, this term called green shoots. And it was basically looking for anything that could be perceived as a positive in a world of negatives. So everybody was wrecked. Everyone was looking for a silver lining. So as we made our way to 2010 to 2011, the market started to rebound. Optimism was building. There was this belief that now, since all was clear, we could get fully invested again. People started feeling better. And that basically lasted for the better part of a decade. So from 2009 up until the end of 2021, that was a pretty good time to be an investor. Right. There were some bumps along the way, and we'll talk about some of those too. But for the most part, that was the golden decade where an investor could pick a ticker symbol and it probably went up. Big tech was in vogue. There was a cult-like following for growth. It was the rise of the Cathie Wood era. Everyone was a genius. It was really tough to miss. And during good times, and I've talked about this before, during good times, investors conclude the good times will keep coming. So essentially extrapolating what's happening today and moving that well into the future. And most people take rising stock prices as a positive sign of things to come. And conversely, most people take falling prices as a sign that things are going to get worse. Okay. And for the purpose of this, I think we're going to discount the 2020 period, right? So that was the apex of the COVID sell-off. That was like a typical market cycle, but condensed in a 30-day period. So as quick as the market fell, it rose back just as quick. That's not to say people didn't get emotional about it. It was just, it was a normal cycle, quote unquote, normal cycle on like crack cocaine. It happened so fast. So the gist of my comments was from 2009 to end of 2021, that was the euphoric part of the cycle, okay? As we hit early 2022, I feel like, and you could probably argue this went back to 2021 and maybe the latter part of 2020, where investors got complacent, right? They became desensitized to risk. They didn't really care what they were paying for an asset, whether that was a stock or a house. There was this FOMO belief, this fear of missing out. If you didn't buy a stock, if you didn't buy a house, if you didn't buy Bitcoin, that you were going to be left behind. Regardless of your risk capacity, regardless of your sphere of competence, regardless of what you were paying for that asset, people wanted to be a part of the upward movement.
It's kind of interesting that people, or it just goes to show how people think about money, but there's this fear of missing out that we talk about pretty often, that if you miss this one time, this one chance, that you're going to be behind or left behind forever. And there's just, I don't know of any time or period where if you missed out, then you're just screwed for life.
Well, it's been said, like there's all these cheeky sayings, but people don't like to sit on the sidelines and watch their friends get rich. Mm-hmm. Like it's a human need to be a part of the herd. Like mm-hmm. we did a podcast in the past about how Americans used to all live in the same type of neighborhoods. They all used to drive the same type of cars, and everyone was comfortable with where they were at because their peers were in the same boat as them. And then with the advent of the internet, you could basically see what everyone else is doing, and what everyone else is doing on social media is basically the highlight reel of their life. So it makes you feel like you're missing out. And now I'm talking about social factors here, but there's certainly some money envy where if you're perusing Instagram and you're seeing your friends on a yacht and driving a fancy car, it feels like you're behind. It feels like you're doing something wrong. And so it basically amplified all of the insecurities, social insecurities, money insecurities, and made people FOMO into things that they usually wouldn't do.
Well, and too, with social media, I think it's become, and just with technology advancing the way it has, with how people are so quickly able to open up a Robinhood account or a Coinbase account, people are sharing their balances and their daily gains, you know, and that's just on Twitter. It may not even be your social circle. You can see anyone anywhere in the world, and people are sharing the details of their lives pretty openly. So seeing that just in your day-to-day feed is really kind of tough on the mental.
Well, Erin, you and I both know they share the good things and then they bury the bad things down mm-hmm. deep and don't tell anybody.
Well, nobody wants to hear about that, and nobody wants to share it either.
So back to our market cycle, which again will be in the notes. So you've got the upswing where people feel great, they're euphoric, it's tough to miss. Then you get the complacency, which is basically the peak where people are desensitized to risk, they're FOMOing into stuff. Now we're in my opinion, we're in the anxiety phase where we're being blitzed with negative headlines. Stock prices are down, crypto is down, real estate is softening, inflation is high, a war broke out. So there's all these things happening. We're being squeezed from multiple sides. You hear about it every day with social media, your friends, the news. And there's this urge for people to do something, right? It's not a full panic sell yet. Like if you look at past cycles, you know, I think the average drawdown in any given year is around 13%. I mean, we're not drastically outside of that, although you could argue there's some subsectors like tech that have gotten it much worse. But it's not a full-on panic sell everything yet, where people would go all to cash. They're angry, they're depressed. You know, there's this narrative that humans build in their heads. They should have seen this coming. So we're not there yet. So back to my comments, we're in the anxiety stage. So after the anxiety stage, and I kind of tease this, but you get into denial, you get into panic, you get into the anger stage. Again, I don't think we're there yet, but as you'll see in the show notes, this graph doesn't necessarily apply to the period that we're talking about, 2009 to 2022, but it does fit with every other cycle. So back to Erin's comment, history does rhyme. Not every cycle is the exact same. The drivers are different, the time is different, but the human psychology piece is probably the most consistent. And the reason why we're talking about this is because we want you to acknowledge your feelings, acknowledge your emotions, and by doing that, I think you're more likely to stay the course, to stick to your long-term investment plan rather than going off the rails and making an emotional decision. So during euphoric periods or during difficult times, humans tend to operate on the extremes. So during good times, during the upswing, reasonable concerns are dismissed. You don't care what you pay for assets. You extrapolate the good times today well into the future. You feel confident. You feel emboldened acting outside of your sphere of knowledge. During bad times, you think things have to get worse. You shun risk. You abort your well thought out long-term investment plan. You stop saving. You make emotional decisions. You seek opinions and information that confirm your negative outlook. And on the other side, you come out of a difficult market environment with scars. Okay.
By scars, do you mean biases, or what does that look like?
Yeah. So I guess I'll use an example. So back, and I've shared this in a blog, but back in 2008, I bought my first house, and I wasn't trying to time the housing market. I was just ready to have my own space. I was 26 years old, and I bought at the absolute worst time, June of 2008. I didn't even know what the term upside down mortgage meant. A couple months later, I was very in tune with what that meant. So that bad experience buying my first house, having my first house worth less than my outstanding mortgage balance, shaped the way that I view the real estate market, right? I have a lot of friends that have made money in real estate. I just can't get into it. I have scars. I have a personal experience that shaped the way that I view that asset class. Okay. So you probably have friends that maybe they got burned in 2008 that have sworn off the stock market as rigged, or, it never ends well for me, or whatever excuse that you have. That's what I'm talking about. A personal experience, an emotional experience that hits close to home, that shapes the way you view something going forward.
And we've talked to a lot of people in the last couple of years who have gone all to cash and it's hard to get back in, who've made rash decisions, changed their allocation kind of after everything has happened. And it just makes the emotional decisions much harder to make.
So that's a good segue into the final piece of all this, because money is emotional, investing is emotional, humans are emotional. So here are some of the things that you can do to mitigate the emotion. I'm not saying that you can get rid of it, but if you think a certain way, if you have self-awareness, if you're honest with yourself, you can mitigate some of these destructive feelings. So the first thing is acknowledge the way that you're feeling. As I've alluded to, as you'll see on the graph, money and emotion go hand in hand, and it's not unusual to be feeling great during a market upswing and terrible during a market downswing. Human psychology is a very real and understated component of investing. So it's okay. Acknowledge your feelings.
What does that look like? What would someone say to themselves to do that? Because I think a lot of people have a hard time really putting that into practice.
You can jot down what you're thinking. So if you're prone to do something, so let's say that you're feeling nervous or worried about the market and you don't want to lose your retirement nest egg and you're thinking about doing something, jot down what you're thinking about doing. And if you placed a trade, jot down what trade that you made and your emotional mindset during that time. Okay. Now, this is not a period to judge, or, it doesn't have to be elaborate, but just jot down, if you sold a stock, if you sold an ETF, maybe one sentence on your state of mind when you did that. Okay. And keep a journal. And then a month goes by, a couple months go by, then go back and look at that. And oftentimes you'll slap yourself and say, man, I was an idiot. Like, I shouldn't have done that. Like I made an emotional decision, but at least you can document it, acknowledge it, and that might prevent you from doing that in the future.
Yeah, that's great.
And then the third thing, okay, so the first thing is acknowledge your feelings. 2 is jot down your mindset, your actions, any trades that you make. Okay, the third thing is acknowledge your biases and blind spots. So I just talked about my personal experience with real estate. If you have a glaring blind spot or a glaring tendency or a glaring disposition, if that's pessimistic or optimistic, jot all those things down. If you have a story about getting wrecked in 2008 or buying a rental property and having a horrible tenant or having the property worth less than the actual outstanding loan, write all that stuff down, because I promise you that does leak into your money attitudes, your decision-making, your disposition. That all leaks in whether you know it or not. Okay, the next one, and this is in the spirit of finding an information filter, but since I say that all the time and maybe you don't take me seriously, we're going to change it up a bit. So seek information that challenges your beliefs. Know that if you have a steadfast opinion on the economy, about an asset class, about a stock, someone just as smart, maybe even smarter, has the opposite opinion. Okay, you want to understand both sides. What most people do is if you're feeling bad about the economy, they'll go read 10 people that feel even worse about the economy, and that confirms your bias. So you want to seek out opinions that challenges your current narrative.
To add on to that too, being able to explain why you feel a certain way is also a very good exercise, because a lot of people will read something and they accept that belief as truth or as their own, but they're not able to explain why they feel that way. And so doing that with your decisions, with your finances, with anything in life is a good exercise.
So on another tangent, and this is not in my notes, but as you seek information that challenges your beliefs, start to keep score. I mean, it's not the worst thing in the world to say, like I personally have been wrong up until this year about Tesla stock, right? I haven't been a big fan of Tesla, but those that believed in Tesla, that invested money in Tesla, have been right. Like there's no gray there. Like they have been right. They've made a lot of money. And, you can say the same about the Bitcoin folks. Like you can naysay Bitcoin, you can think it's made up, you can think it's a joke or whatever. People that invested in Bitcoin have made a lot of money. They've been right. Okay. So it might be a blow to your ego. It might not feel good, but if you're anchored in these identities and beliefs and you've been wrong, acknowledge the fact that you've been wrong. Okay. That promotes a better way to think. It promotes being flexible, being able to change your mind, to having an open mind. These are all attributes of a successful investor.
Yeah, that's good. How about the last one?
So there's 2 more.
Okay, how about the last 2?
Be honest about your capacity to take risk. It's easy to take risk when things are going great. You do not want to find your true risk tolerance during a nasty downturn. I promise you that does not feel good. And a perfect example of this, and I've used this before, up until COVID in 2020, I mean, we had a decade of blissful returns where a lot of people were over their skis seeking more risk than they set out to. The stuff hit the fan and they completely aborted mission. They sold everything because they didn't understand the outcomes, the potential outcomes of how they were invested. And I use the example of a 60-40 portfolio where, you might have thought a 60-40 portfolio was conservative. It went up about 10% a year. It didn't really have any drawdowns because the bonds would offset the equities. And then 2020 happened when a 60-40 portfolio was down 20% in a period of a couple weeks. Okay. So be honest about your capacity to take on risk. Don't go FOMOing into stuff when things are good. Don't go to all cash when things get a little weird. Like build a portfolio that reflects the way that you feel about risk. That starts with understanding your capacity to take risk. And then the last thing, the last one is understand the history of financial markets. Negative outcomes are part of investing. Like there's no investment strategy that enjoys gains without the occasional pain of loss. It just does not exist. But I find most mistakes people make are trying to do just that. They're trying to enjoy gains without experiencing the pain of loss. So, when the markets are going down, don't think of it as you've done something wrong or your portfolio is broken. Think of it as the cost of admission. And the way professional investors think is not in absolutes. So looking at the history of markets, we can understand, looking at 100 years of data, something like 70% of the time markets are going to go up, right? So 60 to 70% of the time markets are going to be boring and they're going to bleed higher. Okay. The other 25%-ish, things could get weird. Okay. Things might get uncomfortable. So if I'm a betting man, that's a pretty good trade, right? If someone said to you, without showing you a stock chart or showing your portfolio balance, that 75% of the time you're going to make 6 to 8%, and occasionally you're going to lose 10%. And if you ran that over the course of 50, 60 years, that's a pretty good scenario to be in if you're an investor. And just for compliance, because I know you listen to this, I'm just throwing those numbers out there. So 6 to 8%, a loss of 10%. That's not a prediction. That's not what's going to happen. That's just me trying to provide an example.
That was a good example. Any last thoughts, takeaways?
No, I think this gets to the core of what this podcast is supposed to be about. As I said, I think behavioral finance, the psychology of money, is often misunderstood. And I think the better that the average investor can understand it and get in tune with their feelings and look in the mirror and ask tough questions, the better you get to know yourself as an investor, and the higher likelihood that you will avoid destructive behaviors.
Yeah, if you're interested to read more about this topic, we will have the chart that we've referenced in the show notes below, as well as a couple of books and different blogs and potentially videos that we have created over the years. So you can find all of that in the show notes. Thanks for listening to this week's episode of Blind Spots. We will see you in the next one.